You know, most traders don't lose because they can't read a chart. They lose because they don't wait for the moment when their mindset aligns with what the market is actually offering. Trading isn't about catching every move. It's about aligning with the moves that have a genuine edge. And that brings me to today's talk, the entry principle that naturally boosts your win rate. If you remember the previous video on identifying early participation from large informed players, this builds right on top of it. Because once you can recognize where high probability behavior begins, the next question is, when do you commit without letting fear or excitement distort your perception? Now let me tell you something that took me years of internal conflict to truly understand. Every trader on the street can see a rising market, but very few can enter it without projecting hope or fear onto it. The market does not reward you for seeing what everyone sees. It rewards you for responding objectively when others are reacting emotionally. So ask yourself, how often have you taken a trade just because the move felt strong? And how often did that same strength evaporate right after you entered? That's not coincidence. That's the natural behavior of a market designed to reveal your internal imbalances. It lures you with certainty, then exposes your lack of discipline the moment you act impulsively. So I developed what I call the entry trap filter. Before I enter a trade, I ask one simple question. Is the market confirming my edge, or is it provoking my emotions? When the market is confirming, it presents clarity. When it's provoking, it creates excitement. And excitement is the enemy of probabilistic thinking. Most traders can identify a breakout. Few can distinguish between a breakout that reinforces their edge and one that simply triggers their desires. The difference, my friend, lies in patience. When you see a breakout, don't buy that first burst of energy. Let it move. Let it retrace. Then observe the nature of that retracement. Does it pull back quietly on reduced participation? Do buyers reappear before half the move is erased? That's your signal that the crowd is acting emotionally, while more disciplined participants are still in control. I always say the market reflects everything. The chart whispers it before the masses express it. Don't just read the price. Read the behavior of the price. When you can differentiate a constructive pullback from a weak, emotionally driven one, you've learned the entry skill that separates the truly consistent trader from the perpetual gambler. Now think about this. Why do most people jump in early? Because they can't handle the psychological discomfort of watching price move without them. They fear missing out. But markets don't move linearly. They surge, they pause, they shake traders out, and only then do they resume. If you wait for that pause, if you learn to sense the market's rhythm, you can enter when uncertainty is lowest and your objectivity is highest. Doesn't that sound better than chasing impulses? You see, a good entry isn't just about price. It's about the internal alignment of risk, perception, and neutrality. You want to be the trader who steps in while others are stepping back. When emotional traders panic, that's often when the more confident participants quietly position themselves. Let's take an example. Say you're watching a market trending upward smoothly. You see a breakout above resistance and a spike in activity. Everyone pours in. But what happens next? Price stalls, pulls back, and the emotionally reactive traders start to panic and exit. That's when I start to pay attention. If price holds above the previous resistance, if that ceiling now behaves as a floor, that's the market's way of saying, my structure is still intact. That's when you enter quietly while others are backing away. Remember in the previous video, we talked about identifying the behavior patterns of informed participants, early accumulation before expansion. Well, this principle is its natural counterpart. Once you recognize those footprints, this entry method allows you to act with them, not behind them. You're no longer reacting to movement. You're synchronizing with probability. But let's not deceive ourselves. No method works all the time. You'll still take losses, and that's perfectly fine. The point isn't to avoid losses, it's to avoid psychologically fueled losses. A quality entry means that when your edge doesn't play out, you lose little. And when it does, you capture meaningful reward. That's how win rates improve. Not through more signals, but through mental discipline. Sometimes I'd track a setup for days without acting. The crowd would jump in, get shaken out, then complain about false breakouts. To me, every failed move was simply more information. Each fake-out clarified the story the market was telling. Because the market always reveals itself, but only to those who aren't rushed by emotion. You want to hear something? The most consistently profitable traders I've ever known didn't make their money by doing more. They made it by perceiving more. By waiting for the moment when price behavior, volume behavior, and crowd behavior all aligned. They weren't trying to prove they were right. They simply waited until the market showed them that the probabilities were on their side. Ask yourself, are you entering because the market is ready or because you are impatient? That difference defines the amateur versus the professional. A professional waits for confirmation, not emotional relief. He knows trading is a game of probabilities, not validation. And here's another thing. Your entry should make sense within the broader structure. Don't take a short-term setup that contradicts a long-term trend and expect consistency. Align your entries with the direction of the dominant market forces. It's like sailing. You don't control the wind, but you position your sail. When you enter correctly, you give yourself the psychological permission to hold. That's where real performance comes from, not the entry itself, but the confidence the entry gives you. You can't stay with a winning move if you're constantly doubting whether your entry was impulsive. That's why this principle matters. It creates clarity, and clarity strengthens your ability to stay. Most traders believe they need more indicators, more signals, more complexity. They don't. They need more certainty within themselves. The clearer the entry, the calmer the mind. And a calm trader outperforms an excited one every time. Now here's something most trading gurus won't tell you. Sometimes the best entry is no entry at all. If the market isn't presenting the conditions that match your edge, stay out. Cash is a perfectly valid position. The market will always create new opportunities. Your capital won't recover if you waste it chasing impatience. So, the real secret to improving your win rate isn't an indicator or a hidden technique. It's knowing when not to trade and when to act with precision. And when you combine this with the principles we covered earlier about reading institutional participation, you'll find that timing stops feeling like prediction and starts feeling like recognition. Because that's what trading really is, recognizing behavior. Recognizing fear, greed, hesitation, conviction. Price is merely the visual expression of those forces. Your entry is simply your response to them. Most traders assume every surge in price is an invitation. They see a bright candle, a fast move, and they jump. But that's exactly how the market exposes emotional traders. What looks like an invitation is often just a test. The ability to distinguish the two is what separates the consistent trader from the hopeful one. When I say invitation, I mean a move that truly validates your edge, a move that confirms strength and maintains that strength in a composed, orderly manner. A test, on the other hand, Is the market probing to see who is still ruled by emotion? It's designed to draw you in before the probabilities mature. One builds your account, the other empties it. Let me tell you something important. Price doesn't move in straight lines because the market needs to assess commitment before continuation. It must test the emotional traders, identify the weak hands, and clear the path. When too many participants rush in too early, the market often dips just enough to eject them. That's the test. And most traders fail it because they mistake the test for a real opportunity. You've seen it happen. Price breaks above a widely watched level, volume spikes, and traders chase it. Then suddenly, the market pauses. It slips back under the breakout line. The same traders who bought from excitement now sell from fear. The market repeats this pattern endlessly. It tempts, it traps, and it teaches. Only traders who've suffered enough emotional pain learn to see the distinction. So how do you tell if it's a true invitation or just another trap? Watch how the market behaves after the move, not merely during it. A genuine invitation sustains its composure. It doesn't collapse back under structure. It consolidates, pauses, and continues. Activity supports the move at the start, and when price pulls back, that activity shrinks rather than surges. That tells you sellers aren't acting aggressively. It's merely the market breathing. But a test has a different tone. The move looks powerful, but the moment you enter, it loses its vitality. Candles shrink, activity fades, and the market feels heavy. It's like walking into a room and sensing tension. You feel something is off. The market expresses uncertainty, not conviction. And here's the essential part. It's not solely about charts. It's about psychology. The market is constantly measuring who is disciplined and who is emotional. A test is designed to expose emotion. An invitation rewards patience. When you learn to avoid reacting during the tests, you naturally position yourself for the clean, high-probability expansions that follow. That's where consistency lives. Have you wondered why large players rarely buy the first breakout? Because they understand it's often a test. They wait for the market to reveal who is committed. They let emotional traders jump first, then acquire shares at a better price. That's the difference between chasing and aligning. The inexperienced trader craves excitement. The experienced trader seeks clarity. The challenge is that the test move often looks identical to the real one, until you observe more deeply. Watch the nature of the pullback. Is it panicked or controlled? Do candles close at their lows or hold near their highs? Every one of those elements communicates intent. Trading isn't about predicting. It's about accurately interpreting. You might ask, how long should I wait? The answer is simple. Wait until the market shows it doesn't need your help. If a stock genuinely wants to move, it will. You don't need to force it. An invitation doesn't scream for attention. It earns it through confirmation. The test demands emotional reaction. Learn to deny that urge. That's where your edge truly begins. Let's frame it in emotional terms. A test move feels urgent because it activates the part of you that fears missing out. It stirs that inner pressure to act before you lose your chance. That is the market triggering your conditioned responses. But an invitation feels quiet. It carries no urgency, no spike of adrenaline. It simply offers a structured, balanced opportunity. When your internal state mirrors that calm, your win rate naturally improves because you're no longer trading from emotional compulsion. You're trading from clarity. I used to think I had to be engaged with the market constantly, that every breakout was a potential reward waiting for me. But over time, I discovered that most breakouts are nothing more than tests designed to expose emotional imbalances. They lure the impatient and punish those who seek excitement more than objectivity. The real opportunities, the true invitations, appear less frequently, but with unmistakable structure. They unfold smoothly, without emotional drama. The best trades I've ever taken never felt rushed. They felt like a natural extension of what the market had already revealed, almost inevitable. There's something crucial to understand here. The test isn't your enemy, it's your instructor. It teaches you exactly what happens when you act prematurely. Each false start is the market reinforcing your psychological resilience. Eventually, you stop reacting at the slightest movement. You stop interpreting motion as opportunity. You start waiting. That's when your perception shifts from guessing to reading. When you view price this way, trading becomes less about prediction and more about observing human behavior. Every test, every shakeout, becomes a rehearsal for the next true opportunity. And once you see the pattern, you can never unsee it. You'll begin to notice how often the market provokes the crowd before revealing the real move. So when you're in front of your charts and price pushes through a level, ask yourself, does this feel like a balanced opportunity or an emotional trigger? Are disciplined traders stepping into this move, or are they standing aside while the crowd exhausts itself? The answer isn't in your indicators. Most traders can identify a pullback, but few understand its message. They see price dip and immediately panic, assuming the trend is reversed. But a mature trader knows that a pullback is frequently just the market releasing tension before continuation. The key is to watch how price retraces, especially with regard to volume. When a stock moves down lightly on declining volume, it's communicating that sellers lack conviction. Those with size are still holding. The underlying support remains intact. That's where the optimal entry hides, quiet, subtle, and nearly invisible to the emotionally driven eye. You see, every trend expresses a rhythm. Price ascends, pauses, retraces, and then resumes. It's never linear, never flawless, but inside that rhythm lies information. A mild pullback after strength indicates that buyers remain in control. A deep retracement with rising volume suggests the opposite. If you can distinguish between the two, you'll know precisely when to align yourself with the market and when to stand aside. Most traders never wait long enough to discover which pullback they're dealing with. They buy at the first sign of movement, only to watch the market breathe and shake them out. Have you ever noticed how the market seems to test your emotional stability? It's as though it wants to know whether you truly trust your edge. That's what a pullback does. It exposes your conviction. Professionals understand this dynamic intimately. They let inexperienced traders chase the breakout. Then they patiently observe the retracement. When volume contracts and price holds, they begin adding quietly. Meanwhile, the emotional traders are exiting in fear, convinced they've made a mistake. The professionals accumulate what the crowd discards, and that's how they repeatedly secure low-risk entries. When you watch a chart, examine the behavior between price and volume. Imagine a strong, decisive move upward on heavy volume. That's the initial impulse. Next comes the pullback. If price drifts downward slowly while the volume bars shrink, that's your cue. Sellers aren't dominant. They're simply taking small profits. The market is resetting, not reversing. That behavior communicates that the trend is intact. But if the pullback happens sharply on expanding volume, that's a completely different signal. It shows sellers acting with intention, not hesitation. In that situation, you don't engage, you stay out. Allow the market to regain balance before you look for an entry. The advantage of low-volume pullbacks is that they provide a clear place to define your risk. You can enter near the end of the drift, place your stop just below the most recent swing low, and if the trend resumes, your reward to risk profile becomes extremely favorable. I used to watch the tape for hours waiting for these moments. They often looked dull compared to the dramatic surges everyone else chased. But that's exactly why they worked. Real opportunities rarely look exciting. They appear controlled, composed, almost subdued. That's when the market is preparing for another leg. The low-volume drift is strength disguised as weakness. Think back to our earlier discussion about distinguishing an invitation from a test. This concept ties directly into that. The muted pullback after a breakout is the invitation. It's the market confirming its intention. It's saying, I've shaken out the emotional traders and the confident ones are still here. That's the moment you can enter with conviction. Not because you're excited, but because the structural evidence aligns with your edge. Here's the truth. Good entries rarely come from predicting the next candle. They come from understanding context. A soft, orderly pullback shows that demand is still present. If you see price holding support while volume dries up, that's the footprint of institutional behavior. Large participants aren't distributing. They're either holding or quietly accumulating. And that's exactly the force you want to align with. Most beginners misunderstand this. They chase high-volume moves because they think activity equals opportunity. But the best opportunities often arise during periods of reduced volume. That's when the noise dissipates and the trend resumes without resistance. You don't want to be the trader buying at the top of collective excitement. You want to be the one entering during the quiet phase before the next expansion. Think of it like breathing. The market inhales during large moves and exhales during soft retracements. Your ideal entry comes during the exhale, when pressure is minimal and opportunity is maximized. A light pullback gives you both, a calm entry and a clearly defined structure for risk. And if you've studied the trend properly, you already know the broader direction of informed money. You're simply waiting for the moment when you can position yourself without battling emotional traders. Have you ever wondered why seasoned traders appear so calm while beginners seem frantic? It's because experienced traders have learned to embrace the slow periods. They know that a low-volume pullback is a gift. It's the market saying, relax, the story hasn't changed. Instead of rushing into volatility, they wait for that quiet confirmation. That's where true consistency resides, in the silence between the waves. Sometimes you'll watch a stock drift sideways for days and feel like nothing is happening. But if that drift occurs on low volume, it's often the calm before a healthy breakout. The professionals are quietly absorbing supply while the amateurs grow impatient, lose focus, and wander away. Then, when enough psychological pressure has accumulated beneath the surface, the next strong move begins. And to the untrained eye, it looks like it appeared from nowhere. But it didn't. It was developing in silence the entire time. This kind of patience doesn't come naturally. It runs against our hardwired impulses. We crave movement, stimulation, the feeling that something is happening. And the market knows this. It feeds off that impatience. But once you realize that a low-volume pullback isn't weakness but a subtle signal of strength, your internal responses begin to shift. You stop reacting emotionally to every downward tick and start observing how price pulls back rather than that it pulls back. Patterns emerge. Behavior becomes readable. What once felt random now reveals design. This is the essence of trading from a higher mindset. Not simply reacting to price, but interpreting its psychological message. Every candle carries emotional meaning. Every volume bar is a tell. Together they reveal who is actually in control. When you see price drifting down lightly on small volume, that isn't fear. That's stability. That's structure. That's the market demonstrating control. When a stock breaks through resistance, that moment feels explosive. Screens flash, volume surges, traders pile in. It feels like confirmation. But the real insight emerges after the excitement fades. What matters most is not whether price breaks above resistance, but whether it behaves with composure afterward. A genuinely strong breakout doesn't need to hype itself. Instead of chaos, you want to see controlled strength. The true hallmark of a breakout with structural integrity is when old resistance turns into new support. That single behavioral shift signals a deep psychological reversal. Those who once defended that level as sellers are no longer present. Buyers take ownership of the zone. This is one of the most reliable forms of confirmation you can ever observe. Every resistance level holds memory. It is where traders previously got trapped, where rallies failed, and where regret lingers. Many traders think, if price ever gets back here, I'll sell and get out. That emotional residue creates resistance. So when price breaks above that level, and then holds above it, something powerful has happened inside the collective mind. Those traders who sold in frustration begin to feel doubt, even fear of missing out. That psychological shift generates new demand. The emotional tide turns, transforming a ceiling into a floor. The mistake most traders make is assuming the breakout is the green light. It isn't. The breakout is the test. The retest is the green light. When price pulls back to touch that former resistance, that's your chance to confirm whether the market's intent is genuine. Does the level hold? Does volume shrink on the pullback? Do buyers reappear in a quiet but confident way? If so, that's your signal. That's where professional traders typically make their move, after the excitement fades, after structure proves itself, when the path is clear. Ask yourself, how many times have you seen price break out only to collapse back under the line? It happens constantly because most breakouts are driven by emotion, not true conviction. The first wave of buyers are often momentum chasers responding to excitement, not structure. But professionals wait. They know real moves don't fear retests. If the breakout is legitimate, it will hold firm once price returns to test the level. That's the market's way of saying, this level now represents confidence. I'm ready to continue higher. Years ago, when I studied charts obsessively, I saw this pattern repeat across every asset class: stocks, futures, commodities, currencies. The behavior never changed because human nature doesn't change. Fear, excitement, hesitation, regret. These emotional cycles replay endlessly. When you can recognize that transformation on the chart, you're no longer reading numbers. You're reading psychology. The level that once represented doubt now represents strength. Keep in mind, this transformation doesn't always happen immediately. Sometimes after a breakout, price will hover just above the old resistance for days or weeks. It's a psychological filter. Impatient traders become restless and exit, while disciplined traders study the behavior, watching volume, structure, and character, waiting for that gentle liftoff. And when it comes, it rarely looks dramatic. It appears calm, steady, almost effortless. No big spike, just persistent demand nudging price higher. That's the signature of a resistance level that has truly become support. Think of it this way. The breakout is the spark, but the retest is the foundation. Without a foundation, the move has no longevity. Every large trend you've ever seen was built on layers of old resistance turning into new support. That is how markets build conviction. When you take an entry during the retest, you're aligning yourself with strength, not emotion. I made the same mistake early in my career that most traders make. I used to chase the breakout. It looked strong, it felt strong, and I didn't want to be left behind. But more often than not, price would retrace immediately after I entered, and I'd be stuck in a losing position. Over time, I learned to wait. I learned that the retest, not the breakout, was the disciplined entry. If the market truly intends to go higher, it will prove it by holding that level. You don't have to guess. You only have to observe. Now flip the perspective. If price fails to hold above previous resistance and slips back below, that's not a reason to panic. It's insight. It means the breakout was driven by weak hands. Sellers still dominate. The crowd acted prematurely. Use that failure to your advantage by stepping aside, not falling into the trap. Each failed breakout that you avoid protects your capital and reinforces your ability to distinguish real strength from emotional noise. When old resistance becomes support, you also gain something invaluable, a logical place to define your risk. Your stop loss belongs just below that newly confirmed support. If the level holds, your trade gains traction. If it fails, you exit quickly with minimal damage. This is what professional trading looks like. Controlled exposure, not perfect predictions. You're not trying to be right all the time. You're trying to be correctly positioned when you are right. This pattern ties into the broader rhythm of market structure. Every higher high and higher low in an uptrend is essentially previous resistance turning into new support. That's how trends build on themselves. That's how sustained movement is created. When you see this clearly, you stop chasing tops and start waiting for the step beneath your feet to form. Have you ever noticed how certain stocks respect their breakout levels almost perfectly? It's not coincidence, it's behavior. These are stocks guided by participants who understand structure. Institutions, funds, seasoned traders. They're not captivated by the excitement of the initial move. They focus on the reaction after the pullback. They buy strength confirmed by control and discipline. When you recognize that moment, when resistance transforms into support, you're no longer responding to emotion. You're aligning with order. It is one of the most dependable signals of market maturity. You're witnessing a shift, not just in price, but in belief. And in trading, belief drives action, and action drives price. Every tick on the chart represents conviction or doubt. When that old ceiling becomes a legitimate floor, conviction has won. So the next time you analyze a chart, don't get fixated on the breakout itself. Wait for the proof that the market has accepted that level as support. Observe how price behaves when it returns to the area. Look at how buyers defend it effortlessly and without urgency. Every trader loves talking about taking action. Very few talk about the discipline of waiting. Protecting your capital by avoiding uncertain setups is one of the hardest lessons in trading. It sounds simple, even dull, but it forms the bedrock of longevity. Most traders believe that being active equals being productive. They think being in a trade means they're maximizing opportunity. But the truth is, the best traders spend far more time waiting than acting. They protect their capital the way a craftsman protects his tools, carefully, intentionally. Because in this business, Survival always precedes success. The market is a master of illusions. It constantly presents setups that look almost right, just close enough to tempt you. Those almost setups are where traders lose the most money. Not because the losses are catastrophic, but because they slowly drain discipline. One undisciplined trade leads to another, and suddenly you're no longer trading the market, you're trading your frustration. Ask yourself, how many times have you taken a trade simply because you were bored, or because you didn't want to miss what looked like a potential move? And how many of those trades became avoidable, unnecessary losses? That's the hidden cost of impatience. The psychological tax traders pay before they learn restraint. Capital protection isn't just about stop losses. It begins before you enter the trade. It starts with saying no when something doesn't align with your criteria. The irony is that doing nothing feels uncomfortable to most traders. It feels unproductive. That's only because they confuse activity with progress. The market doesn't reward effort. It rewards precision. Good trades don't appear every day. They appear when price, volume, and psychology align. Until that alignment happens, your capital belongs safely in your account, not exposed to uncertainty. Cash is a position, a powerful one. It gives you flexibility. It keeps you emotionally neutral when others are trapped by their own impulses. I've seen traders blow up accounts not because they didn't understand the market, but because they couldn't stay still. They kept forcing trades, poking at the market, trying to make something happen. But markets aren't moved by personal effort. They move when conditions align. The more you trade out of boredom, the more you blunt your edge. Each mediocre trade steals focus from the exceptional setup just ahead. Capital protection is about patience, yes, but it's also about clarity. You must know exactly what your ideal setup looks like. So when something falls short, you can pass without hesitation. Sometimes protecting capital means missing trades that actually work. That's part of the probabilistic nature of trading. You'll watch moves happen without you, and it will sting. But consistency doesn't come from catching everything. It comes from catching what fits your plan. The discipline to let a tempting trade go is what separates the consistent trader from the impulsive one. You don't prove your skill by trading often. You prove it by choosing when not to trade. There's a phrase I used to tell myself. No position is better than a bad position. Simple, but grounding. Every time I felt tempted to take a low-quality setup, I reminded myself that being flat means I'm safe, flexible, and ready. The market isn't disappearing. Opportunities don't vanish. But your capital, once lost, requires time and effort to rebuild. And in that rebuilding process, most traders lose more than money. They lose confidence. So think like a sniper, not a soldier spraying bullets.